Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Hello, and thank you for joining me for another episode of the Grow Your Wealthy Mindset podcast. I recently returned from 10 days in Portugal, where I attended the Art and Soul Retreat hosted by Dr. Randy Schachter. Before the pandemic, I had never gone on a wellness retreat. Since then, I've been to the White Coat Investor Conference multiple times, which the full name is the Physician Wellness and Financial Literacy Conference. So I guess that's kind of a wellness conference as opposed to a retreat. In 2023, I attended 3 wellness retreats with empowering women physicians, going to Bora Bora, Puerto Rico, and San Diego. And I really enjoyed those retreats. They were all great, but I think I have to say that this retreat to Portugal was the best. It was certainly the best value for the cost. I love that it was a small, intimate group of women physicians. There was a great mix of activity with daily yoga, pottery, sightseeing, including beach time, as well as free time. The food was amazing, and the accommodations were top-notch. We stayed at this beautiful villa, which had great public space, as well as our rooms were just wonderful. If you're considering any wellness retreat in the future, I highly suggest that you look into the Art and Soul Retreat. Between traveling and working, I batched a number of episodes for this podcast, so now I'm working at producing more content for you. This is a great time to reach out if there's any subject you would like covered on the Grow Your Wealthy Mindset podcast. You can do so by emailing me at growyourwealthymindset@gmail.com. If you pay attention to financial or business news, you may have heard the term stagflation being thrown around, and you may be wondering, what is stagflation and what does it mean for the economy? In today's episode, I'm going to go into more of a deep dive on stagflation. The term stagflation was actually first used by a British politician, Ian MacLeod, during a speech made before the House of Commons in 1965. Stagflation is a prolonged period of time where there is slow economic growth and inflation. It comes from the combination of the words stagnation and inflation. An annual growth rate of less than 2%, as measured by the gross domestic product, is considered stagnation. Stagnation and stagflation generally have high unemployment rates. Inflation is the rising cost of goods and services and can be thought of as the devaluation of money. The United States experienced a period of stagflation in the 1970s that was thought to be prompted by the oil crisis. There were 5 consecutive quarters of negative GDP growth, with a recession from November 1973 to March of 1975. Inflation hit double digits in 1974, ending the year at 12.3% inflation, and unemployment reached 9% in 1975. It was previously thought that the combination of high inflation and low growth was theoretically impossible. This goes to show that economists don't have stagflation figured out, and there's no real consensus about the cause of stagflation. In the 1970s, the blame went to the high cost of oil. The Organization of Petroleum Exporting Companies, or OPEC, had issued an embargo against Western countries in October of 1973. The global cost of oil rose dramatically, and this increased the cost of transportation as well as the cost of producing goods, including getting those goods to the market. Productivity went down, and so growth went down, and prices went up, causing inflation. President Nixon broke from the gold standard in 1971. Prior to that time, the dollar was directly convertible to gold. By going off the gold standard, the government was then able to manipulate the currency by printing more money and have more flexibility to enact monetary policy. If we don't know what causes stagflation, then what do we know about the causes of inflation? Before I answer that question, let me summarize historical inflation rates for you. The Federal Reserve targets an inflation rate of around 2 to 3%. And from 1992 to 2020, inflation has ranged from a low of minus 2.1% in 2009 to a high of 5.6% in 2008. But for the most part, inflation has been in the 1 to 3% range. Inflation was in the double digits in 1974 and 1975, but did cool down to 1979, when double-digit inflation lasted again until 1981. The highest inflation rate in the last 100 years was in 1947, when inflation hit a staggering 19.7%. In the 1980s, inflation ranged from 12.5 to 14.8%. Our recent increase in inflation, that started in 2021, went to a high of 9.1% in June 2022. Current inflation, according to usinflationcalculator.com, is 3.5% for March of 2024. The causes of inflation include an increase in wages and the cost of labor, the increase in the price of raw materials, the increase in money supply, and decrease in productivity. A lot of these factors really tie together. If the cost of raw materials rise, let's say the cost of wood, then the cost of producing goods increase, and usually this results in higher prices that are passed to the consumer. The supply of goods may also decline, and if the demand for the product stays the same, this will also lead to an increase in the price of goods. Wages also affect the cost of production, and payroll is often the largest expense for a business. When the economy is doing well and the employment rate is low, then there can be shortages in labor or workers. Companies will then offer higher wages to attract workers to their business, which increases production cost, and this can lead to higher prices. When people are making higher wages, it also means that they can potentially spend more. When the economy is doing well and people are earning higher wages, then consumer confidence tends to be high, which can lead to more spending. If there is a sustained demand for specific goods and the demand outstrips the supply, then the cost of that product will increase. When fewer items are available, some consumers will be willing to pay more to obtain them, which is the basis of supply and demand. Companies can also raise prices simply if customers are willing to pay more, and this is certainly reflected in the luxury market. Even though the economy is doing well, higher prices still translates to inflation. As prices rise, workers start to demand higher wages to maintain their standard of living. And then, of course, those increased wages means increased cost for the business, which means that they'll raise the prices on their goods and services to cover that cost. Money itself is also subject to the law of supply and demand. As the supply grows, the value of money decreases, and so the purchasing power decreases. Money can also lose value due to general lack of confidence or trust in the issuer of that money, which can cause hyperinflation and has been seen in countries like Argentina. The most popular index to measure inflation is the Consumer Price Index, abbreviated CPI. This measures the prices paid for a group of goods and services, including food, gas, and housing costs. The CPI does not include savings rates or investments. There is also another index called the Produce Price Index, or PPI, which reports the price changes that affect domestic producers. The PPI measures prices for fuel, farm goods, chemical products, and metals. Another index I learned of while preparing this podcast episode is the Misery Index. The Misery Index, which is the sum of the inflation rate and the unemployment rate, measures the economic stress in people's daily lives due to unemployment and inflation. It first came about in the 1970s due to the stagflation environment and was created by economist Arthur Okun. Economists consider full employment to actually be an employment rate of somewhere around 4 to 5%. The Federal Reserve targets an inflation rate of 2%, so that means a normal Misery Index rating is somewhere around 6 to 7%. The average Misery Index under President Nixon was 10.57, and then it went up to 16 during Ford's presidency, and even higher to 16.26 during Jimmy Carter's presidency. Currently, the average Misery Index during President Biden's term is 10.85. For a little comparison to the rest of the world, according to the Misery Index for 2021, the most miserable country is Cuba, with a score of 1,227.6. That's followed by Venezuela with a score of 774.3, and then Sudan with a score of 397.2. Back to inflation. Since we have an idea of what causes inflation, how do the Feds work to keep inflation down? Primarily, this has been done by setting interest rates. By increasing interest rates, credit becomes more expensive, which reduces the supply of money. This decreases individual and business spending. Increasing taxes can also decrease money supply. Governments have also tried implementing price controls. In fact, the reason why health insurance is tied to our jobs occurred during a time where wage increases were capped, so businesses started offering health insurance as a way to attract desirable workers. How can we best protect ourselves from high inflation? If you purchased your primary residence with a fixed rate mortgage before 2021, then you probably want to keep that mortgage. I know people who have mortgages in the 3% range, and that is just unheard of to find now. Locking in low fixed interest rates is a great way to protect yourself against inflation. Generally, you want to borrow when interest rates are low and consider refinancing when rates drop. You want to opt for long-term fixed rates and not rates that can adjust when you get a good rate. Stock markets tend to do relatively better than bonds in a high inflation environment. With high inflation, as interest rates go up, the value of older bonds goes down. When you buy a stock, you're buying a piece of a company, and those companies tend to pass higher costs to consumers, which then protects profits. You can also invest in assets that act as a hedge against inflation, like gold and real estate. Rental real estate property is especially attractive when inflation hits because landlords can often raise rents in order to keep pace with inflation. If you have a fixed interest rate for your mortgage, your income can increase at a rate that's greater than the rate your expenses are increasing, even in a high inflationary environment. As interest rates do increase, high-yield savings accounts and CDs typically will offer more favorable rates. We're seeing this now with some CDs offering above 5%, and Wealthfront is currently offering 5% interest rate with another 0.5% promotion with a referral. If possible, you do want to find a rate that's above the rate of inflation to keep the value of your money from eroding due to inflation. This is also in I-bonds, or Treasury inflation-protected securities, abbreviated TIPS, can make sense. I personally purchased I-bonds recently that had a fixed rate of 1.3% on top of the rate of inflation. Hopefully, we will see inflation stay in check and the return of growth to our economy. Worrying about the economy doesn't actually have any benefit. Learning and then taking action and making good choices with what we do with our money is what will lead to actual financial success. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. I'd really appreciate if you could share and let other people know about the podcast. I like to reach as many people as possible. So tell your friends, colleagues, or even post on your social media that you enjoy listening to the Grow Your Wealthy Mindset podcast. See you next week. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.